Kimberly Loftus, and here is your In the Money Extra. Today I just wanted to have the talk, me and you, about how using credit works and how it can impact your future in a little more detail, as well as answer some viewer questions. Let's say you want to buy a pair of new jeans at the store. You pull out your credit card and the store runs it through the machine. It's approved and off you go with your purchase. Behind the scenes, the bank that issued the credit card has paid the merchant, who in this case is the store. Eventually, the bank sends you a credit card statement because in essence, the bank gave you a short-term loan for those jeans. You have the option to pay in full for those jeans, for which you would not pay any interest, or you can just pay a lesser amount, but then the bank will charge you interest for using that short-term loan. You will continue to pay interest and a portion of the cost of the jeans until it's fully paid off. Now that you know how credit works, let's go into how to manage. How you manage your credit, be it credit cards, car loans, and mortgages, can directly impact your job prospects as one example. In my line of work of being a financial executive, employers run a credit check as part of the hiring process, since they need to know if I could be trusted to manage their money. So it's important for me to maintain good credit. How you manage credit can also affect your ability to access loans. If your personal credit is in shambles, it will be very difficult to get business credit. Many lenders require personal guarantees for new businesses since the business itself has not yet built any credit history. How you manage your credit impacts loan and mortgage terms, such as the interest rate. The better manage the credit, the lower the interest rate, and vice versa. In other words, if you aren't paying your creditors on time consistently, you're seen as a higher risk, which means higher interest rates. But if you do pay on time consistently, you're rewarded with interest rates, which in the end costs you less to have that pair of jeans. How you manage your credit also impacts your emotions. I know, and you are more than what shows up on a credit history report, but it can still be devastating, but it's fixable. To improve your credit history, you first need to know how lenders view your credit history, and that is in the form of a credit score. FICO is one of the wider known credit grading systems. Notice I said credit grade, which means it takes account not only your credit history, but other factors to arrive at a credit score. Payment history and the total amount owed in all forms of credit have the most impact on your score. The higher the score, the better you are perceived as being able to handle credit in a positive way. There are also other scoring systems, such as VantageScore, which may look at various factors differently than FICO. Now that I have went through how credit works and credit reports, let's answer some viewer questions. Joining me to read the viewer questions is my daughter, Sienna, for which any chance I get, I'm trying to drop some money knowledge. Hi, Sienna, what's the first question?
How can I check my credit score and credit report?
There are three main companies known as credit bureaus that track your credit history, including type of credit, amount, payment history, and timeliness of payments. They themselves do not create credit scores, but you will be able to go to their website and at least once per year get a free credit report to check your report.
What is considered a good or bad credit score, and what impacts it?
The higher the score, the better. Scores typically range from 300 to 800. As far as bad scores, I would say it's more like a challenge score. It is fixable. The biggest impact is from the total amount of debt you have and timeliness of payments. If you just pay on time, it has a very big positive impact. Other factors include length of credit history, if you've been adding a lot of new accounts in recent months, and types of credit. Long-term credits, such as mortgages, are more favorable than credit cards.
How much debt is too much, and what are the consequences of having high debt levels?
As I mentioned, total amount of debt is a factor of your credit score. The thought is that if you have too much debt compared to your income and you run into some financial hiccups, you are more likely to not be able to pay. The rule of thumb is to have a 35% or less debt to income ratio. This means for every $1 you bring in after taxes, you have 35 cents in credit payments. Put another way, if you bring home $3,000 a month after taxes, your credit payment should be no more than $1,050 per month. Depending on the lender, the 35% requirement may be higher or lower. If you have too much debt, you'll be prevented from getting more debt.
What are the different types of credit, and which is best for my situation?
Types of credit includes credit cards, personal loans, and loans attached to an asset such as a car or house. An asset is something that has future value, so a pair of jeans would not be considered an asset. The type of credit you choose will depend on what you're purchasing. For example, a house is a large purchase, so it makes sense to take out a long-term mortgage.
How can I build credit history and establish a strong credit profile?
Pay your bills consistently on time. Think about automating your payments from your bank account. Also, create a budget using the 50-30-20 rule to make sure you don't take on too much debt. You can learn more about the 50-30-20 rule in our In the Money budgeting episode right here on cantv.org.
How can I negotiate with creditors and resolve disputes on my credit report?
Communication is key. When you ghost a creditor, they don't know how they can help you. So if you're behind, there may be room to change your credit terms until your situation improves, but you won't know if you don't communicate. Also, if you have some disputes on your credit report, communication is also key.
How can I make smart financial decisions to manage my credit and maintain a healthy financial profile?
Monitor your credit, pay creditors on time, and only take on credit that you can comfortably afford based off your budget. If you have any money questions, drop an email to inthemoney@cantv.org, and we may read your question on air. Please make sure to check out our other episodes at cantv.org. Thanks for joining us today for this web exclusive.